This is the Daily Market Rundown live from the Tradelo Trading floor. It's January the 24th and some highlights from today's show. Crypto markets are now on borrowed time. Sterling hits into resistance and inflation expectations in the US are rising. Good day, traders, and welcome and happy Friday to all of you. What a week it's been, of course. It's been all about Trump this week. And again, there's quite a bit of Trump news overnight. Now, I'm not going to go through all of it. I think that's up to you to make sure you're up to date as to exactly what he's saying. He did speak at Davos yesterday, and he kind of said a lot of the same things. I think two key things that he said that were not necessarily new, but definitely were emphasized in particular was one, he wants lower interest rates. Okay, he believes that he can have low interest rates as well as low inflation at the same time. He was actually prompted on that question, that exact question, and he kind of danced around. I'm not sure he gave any kind of a concrete example as to how you can have low inflation and of course, low interest rates. He did lean on the idea that he would get it via lower oil prices. And so that kind of looks what his stance is going to be. He's going to try to drive down inflation by driving down the price of oil prices. And in tandem, he will then get his desired lower interest rates. Now, one thing to pay attention to, Trump in his first stint as president was very much against a strong dollar environment. And we do know, of course, Wall Street consensus this year is very much for a very strong dollar. And there's nothing fundamentally that suggests that that trade is unstuck. We still have significant rate differentials between the US and everyone else. And guess what? The United States is growing 2.5+% GDP this year. Everyone else is stagnant and not growing at all. So there's really nothing that suggests ultimately that you want to be shorting the dollar. And with that in mind, we've of course had some PMIs out in Europe this morning. Let's turn our attention and talk about the UK's PMI. It's an interesting one because I think at a composite level the numbers have come out slightly better than expected. But when you look in a little bit deeper, the way economists see it is very much a stagflation environment forming in the UK. Why? Well, Rachel Reeves' policy late last year effectively dented a lot of hiring confidence. So we've seen a lot of job losses over the course of the last couple of months. And the thinking is that this PMI is nothing other than just a one-off type print. And it does muddy the waters, of course, for the Bank of England, where they're expected to cut 3 times this year. But will they have that ability to cut if inflation is proving to be sticky as it is? So a bit of a damn squib read in the PMIs, but what it has done, if we turn our attention to the chart, is it's actually brought us into very key overhead resistance. We've spoken about this area for a while, 124 on the spot. I think you can now very much initiate those shorts in pound. You're getting a little bit of a gift here. Keep in mind we were trading 121.75 at the start of this week, so we really have run into a very decent area to start selling sterling. And of course, we've spoken about the euro. That's also a very good one to sell. In a moment, we'll talk about the dollar index, which will sort of give us a little bit more confidence that this is the right time to now be short the pound, in particular against the dollar. Now, let's turn our attention and talk some of the other key sort of news that I think is worth talking about. That's all about cryptocurrencies. Now, there was some expectation going into yesterday's Trump signing that he'd specifically referenced the reserve currency and Bitcoin's role in that. In essence, I think this. I posted this video in the Discord channel. Go and watch it. I think it's 6 minutes. That's definitely worth your attention. And it's all about David Sachs. He's leading up the sort of committee that's looking into the whole cryptocurrency. And I think the key summary of it, just to summarize it for you, what the United States is trying to do now is they're trying to position themselves as the part of the world where they are crypto friendly. Okay, in other words, there's a very clear regulatory environment as to what you can and cannot do within the United States. Now, that does not mean pro Bitcoin. It just means that you can come to the United States, set up a crypto digital type business because you know what the rules are. Okay, you can pay your taxes like every other business, and there's no murky water where you're concerned that the SEC is going to be on your back every 5 minutes. Now, I think that was the first key takeaway from that video. The second key takeaway was very much this idea that I think the US is now going to very aggressively pursue some form of a dollar digital currency. Okay, obviously they're moving away from this idea of central bank type CBDC coins, but they are very much looking into this idea of having some form of a tether-like coin where effectively it's one-to-one against the United States dollars, and it's actually backed and audited by US treasuries or US very assets that can be used as collateral. Okay, the point is that this seems like the direction in which the United States government will move. And if you cast your minds back, there was a report late last year looking into the kinds of flows being done via digital dollars. And it very much points to the direction of trade, is that we're going to see a lot more businesses, companies start to settle and transact in digital dollars. Why not? It is the future. Okay, and I think this is why ultimately the US government is positioning itself as some form of a pro-crypto type regulatory environment. Okay, it makes absolute sense. Whoever can provide those services ultimately will earn the commissions from it. Okay, so those were the two key takeaways. Now, none of that points to an environment of lump in, buy Bitcoin at highs, and you're going to get double your money back. Nothing like that sort of thing. What it does do, yes, it does cement cryptocurrencies or digital coins as something that we will be seeing and hearing of into the future, of course, but not perhaps in the way we think, where you buy an NFT picture of someone for $10 million and you clean up. Now, the other key takeaway, he was prompted on this, and I think this is the part to listen into. He was very much prompted on the idea of, what about Bitcoin as the reserve currency? And I think there's something that's very important to lean into. He very much said that, yes, we are looking into holding coins as part of a strategy, but it's something we have to look at. We have to look into it, and it's a 6-month review. In other words, they're going to review it. Now, what I can tell you, if you are ever going to have Bitcoin being adopted as a reserve currency of the United States of America, this is not something that's going to be lightheartedly signed off by Congress in 6 months. This is something that will take a couple of years to really ensure that all congressmen, senators really understand ultimately, what it means to use Bitcoin as a reserve currency. Okay, so just be very aware. I think everyone is long Bitcoin on this idea of the reserve currency coming out anytime soon. The reality, it's not. Okay, so keep a close eye. I think the key sort of levels are, look, we're hovering just below record highs, so there is still a lot of enthusiasm around this crypto bill that was signed yesterday, but I do suspect that they're on borrowed time. Okay, keep a close eye on it. Below 102,000, I think all those positions get washed out again. We trade back down to 90,000, and we stay within this 90 to 110,000 range. Okay, now, sorry, that was a bit of a long one, but I had to get that to make sure that you understood it. Let's talk a little bit about break-evens. They are rising, and what I want to point out on this chart is, yes, I want to be careful to say this is like 2020, but what I want to show you is that when inflation expectations sort of consolidate and then break out, you got to think of inflation expectations a little bit like a trend. Okay, it's when they become embedded, they tend to typically trend, and when they trend, they don't turn around very easily. Why? Because everyone's expectations is for higher inflation. Now, we've seen a very similar type pattern, which started once, of course, the Fed began the process of cutting very aggressively. We then went into a sideways range for Q4, and guess what? We've now broken out of that range. Keep a very close eye on these break-evens. I think it's something that we've been talking about for some time. We're at the highest level since 23, and we do have a Fed that now thinks they're still going to cut twice this year. Okay, in other words, I think the bar is very, very high for a Fed to become more hawkish, for a Fed to pause indefinitely, and effectively for the Fed to perhaps even consider hiking again at the end of this year. Okay, that's kind of my consensus feeling of it. The markets are not pricing that in. The markets are very much priced for a soft landing scenario where, the Fed can cut, hence why equities are now posting record high after record high. That in mind, of course, I spoke earlier about the dollar. As you can see, we are now back testing very key overhead resistance. This was sort of a range that was established for a good 2 years. We broke out of that range in December on course on the hawkish Fed. We've now come back to test it. And guess what? The consensus is everyone wants to be long dollar. You may as well join the party and get long dollar. Okay, we've come into this nice and aggressively as well, which is always good to see. It's very good to see quite a bit of aggressive sort of sell side action into key levels, because that's the one that if you fade, you should go inside pretty quickly. Okay, keep an eye on euro and pound today. I think both of those are very good short side trades. Don't be surprised to see both of those trade back towards unchanged today, and of course next week we should see further sell side action in both currencies. Okay. Let's turn our attention then to one of the key equity indices. This is the Russell Index. Now, the reason I'm showing you this is because Russell in a 4.5% interest rate environment is always going to struggle. Okay. Now, if you've been watching Nasdaq, S&P this week, they are back at record highs, or just a whisker off for the Nasdaq. S&P, of course, has gapped and closed in the cash market at record highs yesterday. But what we can see is the Russell is, a significant way off those record highs, and that is just showcasing that underperformance we've had over the course of the last month since the Fed effectively said, look, we're going to need to cut a lot less than expected. Okay. What I do want to point your attention to is Russell's not something I'll trade frequently, but on a chart level is something I'm going to be very closely watching, because I do want to be partaking, particularly in the short side, once we're back below that 2300. Okay. What you'll notice is that 2300 has acted as resistance once, twice, 3 times, 4 times. It gapped up above it, acted as support, acted as resistance, acted as support. It is a level the market pays attention to. Okay, 2300, should we see a little bit of risk off come back into the markets, I think Russell back below 2300 opens up a decent 100 point move to the downside with relative ease, hence why I'm interested in it. Okay, it's one of those I think you get paid relatively fast with very little risk involved. So pay attention to that. When does it come? Well, I think you need a little bit of risk off. And to get that risk off, I think you're going to need bonds, of course, to tick higher in terms of yield. Now, what creates that potential? Well, look, like I said, I think if you look at the PMIs this morning in Europe, they weren't exactly bad. They were quite decent numbers, but the key is always going to be the US. Now, PMI is a leading indicator of growth. And what I want to draw your attention to is that you can see we had a little bit of a dip in the PMI composite middle of last year that led, of course, to this sort of feeling that we were entering some form of a slowdown. Of course, we had the bad July non-farm payrolls. Everyone thought we were in a recession because of the SAM rule, blah, 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 blah. Turned out we're not in a recession. Turns out unemployment's back at 4.1%. Turns out everything's fine. And turns out that we're starting to see a reacceleration. Okay, when PMIs reaccelerate, you know what comes next? It's called inflation. Okay, if the PMI is accelerating, it means the US economy is accelerating, which means inflation is now not just going to be sticky, but it's going to start to tick up higher. Hence, break-evens tick up higher. Hence, yields should start to reflect that. Okay, keep a very close eye on this today. We have got this out later on this afternoon. Should we tick up anywhere around that 56.5, 57 level? Okay, it's just going to ignite more calls for this idea that the Fed is pausing indefinitely, and the Fed will need to be hiking interest rates a lot sooner than what everyone else expects. Okay, hot number today is not going to be good for yields, and it's not going to be good for equities. Okay, keep an eye on that. I think that's one of those things that is a little bit of a, I don't want to call it a black swan. I think it's one of those things that should we see a strong number, and should inflation yields start to move a little bit higher today, that could perhaps put that offer into equities. But I've been banging on about this all week. The equities are vulnerable, yeah, but the price action does not reflect that yet. Okay, if you look at what yields have done, they've pushed higher this week. If we look at ultimately, what the S&P's done, we're back at record highs. Okay, so right now equities don't care two hoots ultimately about what yields are doing, but we are very much overbought. The VIX is very much moving sideways. So again, a little bit of an air pocket in the market. Should those yields push higher, there is that possibility of a drop down lower, but like I said, it's Friday. Perhaps everyone's long. No one's interested in bailing out of those positions until we get something significant that suggests otherwise. Right, that's a wrap for it today, as well as for this week. If there are any other questions, do post them in the Discord channel. Otherwise, as always, it's a Friday. You don't make your weeks on Friday, but you can ruin them. So don't be ruining your week. Just take those clever plays, be smart about it, manage that risk, and of course, always go make some money.